In this video, we're going to look at legal principles of insurance, sometimes known as fundamental legal principles. This is primarily from Chapter 9 of the Rada-McNamara text. Let's start with a look at the outline. First, we're going to discuss the principle of indemnity. We've already begun to discuss this concept, but we're going to look more deeply. We're going to look first at its definition and purpose, and we'll look at when exceptions to indemnity exist, such as valued policies like life insurance and jewelry, and replacement cost and cost sharing. Then we'll look at methods insurance companies use to enforce indemnity, such as actual cash value, insurable interest, and subrogation. Then we'll switch gears and look at the concept of utmost good faith. First, its definition and history, and how insurance companies enforce utmost good faith. Then there's the basic requirements of a contract and some of the unique requirements of an insurance contract. So let's get started with the principle of indemnity. Indemnity has been defined as financial restoration. It generally means restoring someone to the same financial position they were in before a loss. So, for example, if a home burns down, the insurance company provides financial assistance so that the home can be rebuilt to its prior financial condition. But it's important to note that financial restoration not only means that an insured should be made whole, but that they should not profit from a loss. The purpose of indemnification, meaning that the insured should not profit from the loss, is to reduce moral and morale hazard. An insured who could profit from a loss if they destroyed or damaged their property would be less likely to avoid moral hazard and less likely to be careful to protect themselves and their property from loss. So let's look first at exceptions to the principle of indemnity. They are valued policies, replacement cost, and cost sharing. Indemnity is often violated when the value of a loss cannot be easily or clearly known. This might result in over-indemnification, or there is an extreme potential morale and/or moral hazard problem, which sometimes results in under-indemnification for the insured. First, there's valued policies, such as life insurance. As we talked about in the last video, life insurance protects something which cannot be easily valued. That is, what is the loss in value to survivors of an insured, to their family, to their business partners, to anyone who is financially dependent on them. As I said before, even if an economist can come up with their future earnings potential and assess a value based on that, that doesn't necessarily represent the financial value that that person has to his or her family or business partners. So the way that the insurance industry has dealt with that is to assign a value to the policy before policy inception. Therefore, at the time of the death of the insured, that is the value paid, and there isn't a need to assess the value at the time of loss. Same with works of art in a different way, in that the value of the art is assessed before the loss so that there's no dispute over that value at the time of the loss, since different people might put a different value on various works of art. Another example is jewelry. Jewelry, again, needs to be appraised and valued by someone who is an expert, and then that value is what is placed on the valued policy for the insured. Antiques, again, difficult to value except by experts. There are also valued policy laws in some states. Valued policy laws require the insurer to pay policy limits if there is a total loss, particularly when the value of the property has gone down over time. This prevents an insurer or agent from encouraging an insured to over-insure. However, it sometimes does result in significant morale and moral hazard, particularly when The value of property has gone down significantly over years, but the insurer is required to pay policy limits for a loss. There is a strong incentive for an insured to burn down their own home if the value of the home is much less than the value of their insurance policy. Next, replacement cost, another exception to indemnity. This allows an insured to obtain new property or replace old property at the new cost. In other words, this would be the value placed on property. You should look at Liberty Mutual's website, which explains auto insurance and better car replacement. Instead of just being able to replace your car with a car of the same or similar age and condition, you actually get to replace your car with a better car. This is one step up from typical replacement cost. This is more common in personal or business property than it is in real property, such as buildings and homes. In other words, your contents are often covered at replacement cost, while your property itself is covered at actual cash value. It does result in over-indemnification. The insured might be better off from a loss because they get a new item of property to replace something that's old and possibly worn. Next, cost sharing. Cost sharing helps to reduce moral and morale hazard, especially for areas where the potential for morale and moral hazard is high. Deductibles, co-payments, and co-insurance are all part of cost sharing. These are very common in property insurance and health insurance, but they do not exist in life insurance, and they're uncommon in liability insurance. We'll look at these as we discuss each of those types of insurance. Next, let's look at 3 ways insurance companies enforce indemnification. First, insurable interest. An insurance policy requires an insured to have insurable interest in whatever it is that's being insured. The definition of insurable interest is that an insured must be in a financial position to lose in order to have insurable interest in that thing. Let's look first at property. In order to have insurable interest in property and in casualty exposures, the insured must have ownership of the property or business which it's insuring, or it could be a bailee, have the care, custody, and control of property. For example, a dry cleaner has care, custody, and control of the clothing that it's cleaning. If something were to happen to that property, the dry cleaner might be liable. This is different than typical liability coverage. Next, if someone is a secured creditor to property. The most common example of this is when there's a mortgage on a home. The lender actually has insurable interest in the home because the home is being put up as collateral for the loan. And last, a customer, buyer, supplier, or leading location all have insurable interest in property and in a business that they are associated with. For example, if a company has one supplier of a significant material that goes into its process, such as steering wheels for a large auto manufacturer, and that supplier experiences a covered loss like a fire or explosion, it might shut down the business of the auto manufacturer temporarily. That's why the auto manufacturer has insurable interest in the going concern of the supplier. A leader is a main location, sometimes called a magnet location, at a shopping center, for example. Take one of the larger stores like Dillard's or JCPenney at a mall. Those stores tend to attract customers, and if something were to happen, such as a fire or a significant windstorm in one of those stores, it might have a significant impact on the business income of the other surrounding stores. Again, those stores now have an insurable interest in the leader or magnet location. There is no easy way to establish whether someone has insurable interest in another person's life. So the way the insurance companies deal with this is to simply say that you have insurable interest in yourself. Therefore, you can go and purchase an insurance policy with yourself as the insured and designate anyone you want to as the beneficiary. Next, you have insurable interest in a close relation. These include a spouse, a sister, a brother, a parent, a grandparent, but it doesn't include cousins, aunts, and in-laws. So, for example, a husband could buy life insurance with his wife as an insured and name himself the beneficiary. Similarly, a person could buy life insurance on their child and name themselves the beneficiary. Next, if you have a pecuniary interest in the insured, you can purchase insurance on them. This is a financial interest, such as a business partner, or also a business that has a key person who generates significant revenue for that business. You can buy life insurance on that person, naming them the insured and yourself the beneficiary, or the organization can be the beneficiary. Imagine if a person did not have to have insurable interest in another person. You could purchase insurance on anyone, even someone with whom you have an adversarial relationship. This would be a significant moral hazard issue. Now let's talk about subrogation. With subrogation, the insurance company steps in the shoes of the insured in order to collect damages the insurer has already paid to the insured. This is common when there's an accident and the loss is someone else's fault, but the victim has property insurance. What will typically occur is that the property insurer pays the loss first, less any cost sharing. So, for example, say I get into a car accident with someone, but it's the other person's fault. I would probably collect from my insurance company under my collision coverage for the damage to my vehicle, less, for example, my $500 deductible. But then my property insurer will subrogate against the liability insurer, in other words, the insurer of the person at fault. The property insurer will pay the cost sharing back to me, the deductible, and keep the rest of the loss amount. Let's look at a specific example. So let's say a neighbor's tree falls on Dee's house, causing $6,000 of damage. Dee's homeowner's insurance will pay $6,000 less her $1,000 deductible, or $5,000. Let's assume, though, that it was the neighbor's fault that the tree fell on the house, and the neighbor is considered legally liable. Dee's homeowner's insurer will subrogate against the neighbor's homeowner's liability insurance. Both the property insurance and the liability insurance are part of a typical homeowner's insurance policy, which you'll see in just a few chapters. The neighbor's insurance will pay the full $6,000, and Dee's insurer will cut another check to Dee for the $1,000 deductible. Let's now look at the purpose of subrogation. It prevents collecting twice for the same loss. Even though Dee is actually eligible for both types of insurance, first as a policyholder under her property insurance and then as a claimant under her neighbor's liability insurance, it wouldn't be appropriate for an insured to be able to collect twice for the same loss. This would be over-indemnification and would be a significant moral hazard problem. Second, it holds the guilty party or the person who is liable or negligent that causes the loss ultimately responsible for the damages. Next, actual cash value. Generally, when insurance companies use this approach, they're assigning the actual cash value to property. So the older the property, the less the insured gets. Actual cash value is defined as replacement cost less or minus depreciation. This will discourage moral hazard because you don't get as much for older property as you would if you had a replacement cost value. Now let's look at the doctrine of utmost good faith. Utmost good faith means that a higher degree of honesty, disclosure, and trust must be imposed on this transaction than other contracts. This started with the earliest of insurance contracts. I'd like you to watch the video below by going into the Prezi and opening it up in YouTube. It's a great depiction of how important it is that there's trust between the insured and the insurer. You have to consider the uniqueness of an insurance contract. It's one where an insured gives money to an insurance company and believes and hopes that it keeps and protects the money and is able to pay a claim at the time of loss. But on the other hand, it also means that an insurer has to have faith that the applicant for insurance is being honest about the riskiness of their exposure. As I said, the insured must trust the insured that the money will be there when the insured has a covered loss, and the insurer must trust the insured that the insured is telling the truth about the risk and the loss. How is utmost good faith enforced? And we're going to look at how utmost good faith is enforced against the insured. But there's an entire chapter on government regulation of insurance. The government, state governments in particular, step in to ensure that the insurance company is exercising utmost good faith. All of these will make an insurance contract void or voidable. First, misrepresentations. If it's discovered that the insured has lied in an application for insurance, the policy is void or voidable. However, that statement must be material. So, for example, if someone accidentally gives a wrong home address in an application for business insurance, it's unlikely that this would be a material fact having anything to do with the riskiness of the exposure, and it wouldn't result in contract voidance. Next, there's a breach of warranty. A warranty in an insurance contract is a promise in the contract, and typically warranties are made by the insured to the insurer. So, for example, an insured might promise to maintain a fence around its property. If, however, the fence is not maintained, policies can be void. An insurance company can even avoid paying a claim if they discover that a warranty has not been upheld, even if that was not the cause of the loss. Concealment. If it's discovered that an insured concealed something, like a meth lab in their basement, which obviously is risky for the insurance company, this would void the policy. Now let's look at characteristics of a legal contract. We'll start with the basic characteristics of a contract. First, there's offer and acceptance. Offer and acceptance in an insurance transaction occurs when the prospective insured applies for insurance and submits the application. Acceptance occurs when the insurance company decides to underwrite the policy and issues the policy. It's also called issuing a binder. It's when an insurance company binds themselves to the risk by issuing the binder. In property insurance, this can actually be oral, but in life insurance, it must be written. So, for example, I could go into an insurance agent and apply for auto insurance, and if the agent tells me I have auto insurance before leaving the office, and I have an accident in his parking lot, I could actually have coverage under that policy even though no actual policy has been issued. Consideration in a contract is the exchange of value. Usually it's money in exchange for something that the other party values, such as a carton of eggs or a service like a lawn service. But in insurance, this is a little harder to define. What does the insurance company offer to the insured? Obviously, the insured offers money in the form of a premium, but the insurer offers the promise to pay. And in some cases, this might be much more than the value of the premium, or it might be much less. And we'll talk about that again in a moment. Next, parties to a contract must be competent parties in order for it to be a legal contract. This generally means that they must be of a certain age and that they must not be intoxicated or insane. But in insurance, this is not nearly as big a deal as in other contracts, and you'll see why in just a moment. Next, a contract must be of legal purpose. So, for example, an insurance contract must be insuring something of legal purpose. Take our meth lab, for example. Not only is this something that would be very risky to the insurance company, but it's not legal. Therefore, it wouldn't be a legal contract for the insurance company to insure a meth lab or any other illegal activities. Now let's look at distinct or unique legal characteristics of an insurance contract, and there are quite a few. First, the insurance contract is aleatory. Next, it's unilateral. Also, it's a conditional contract, and it's a personal contract. And finally, it's a contract of adhesion. Let's look at each of these individually. An insurance contract is aleatory. This means that it is an unequal exchange of value. Remember that it's the premium for the promise to pay. Sometimes an insured pays a premium for year after year and never has a loss. But on the other hand, someone might pay a premium and have a loss shortly after policy inception. Take life insurance, for example. Say an owner of a policy, usually the insured, pays the premium for just a couple of months and then unfortunately dies. So maybe the insurance company has received a couple $100, maybe even for $1 million term life policy. In that case, the beneficiary will get $1 million even though only $500 was paid on the policy. So either side can win. But remember that the insurance contract is not gambling. Remember that it's the pooling of risk. It's the premium of many to pay for the losses of the unfortunate few. Next, the insurance contract is unilateral. This means that it's legally binding only to one party or one side. Guess which side? The insurance company is the only one legally bound to perform. Unless the insured stops paying their premium, the insurance company has to abide by the terms of the contract. There are some conditions under which they can cancel the contract, but most of the time they have to continue the contract, whereas the insured can cancel the contract at any time and receive a refund of premiums for the portion of the policy period that hasn't expired. This is one reason why competent parties isn't that significant in an insurance contract, because the insured is not legally bound to perform. Next, an insurance contract is conditional. Insureds have certain conditions that they must abide by. Those conditions are actually in the insurance policy. We'll talk about some of those conditions when we look at the chapter Analysis of Insurance Contracts. Stay tuned until then to learn more about the conditions. Also, an insurance contract is a personal contract. It's a contract between the insured and the insurance company only. Therefore, it cannot be transferred, for example, to a new owner. So, if you sell your house, the new owner cannot take your insurance policy. They have to get their own insurance policy on the same house. And finally, it's a contract of adhesion. This is a really important aspect of an insurance contract. This is because it's drawn up by one party and adhered to by the other. The insurance company draws up the contract, and the insured generally has to adhere to all of its terms. Therefore, it's the responsibility of the insurance company to make the policy clear. Any ambiguity in the contract, because of a contract of adhesion, is interpreted in favor of the insured. I personally have been involved in some cases as an expert witness where the insurance contract was somewhat ambiguous and the insurance company ended up having to pay for something they didn't intend to pay for. This is why most insurance contracts are standard, especially in the personal lines, such as auto insurance and homeowners insurance. This is because the courts, the legislators, and the regulators all consider it very important to protect individuals. There is some ability to negotiate corporate insurance policies, but primarily only in the endorsements. Policies can be negotiated in the excess and surplus lines, so that's where the contracts get a little more interesting. But a standard contract is a contract of adhesion, and therefore the insurance companies try very hard to make those contracts clear. They use the same tested wording year after year. Occasionally wording will change, but for the most part, policies stay the same. And that's the end of our discussion of legal principles or fundamental principles of insurance.